Our video today will explain about transfer pricing and the objective of transfer price. What is transfer pricing? Transfer pricing is an accounting practice that represents the price that one division in a company charges another division for goods and service provided. Transfer pricing allows for the establishment of price for the goods and service exchanged between subsidiaries, affiliates, or commonly controlled companies that are part of the same largest enterprise. Transfer pricing can lead to tax saving for corporations. Two tax authorities may contest their claims. How the transfer pricing works? Transfer pricing is an accounting and taxation practice that allows for pricing transactions internally within business and between subsidiaries that operate under common control or ownership. The transfer pricing practice extends to cross-border transactions as well as domestic ones. A transfer price is used to determine the cost to charge another division, subsidiary, or holding company for service rendered. Typically, transfer prices are reflective of the going market price for that good or service. Transfer pricing can also be applied to intellectual property such as research, patents, and royalties. Multinational corporations or MNC are legally allowed to use the transfer pricing method for allocating earnings among their various subsidiary and affiliate companies that are part of the parent organization. However, companies at times can also use or misuse this practice by altering their taxable income, thus reducing their overall tax. The transfer pricing mechanism is a way that companies can shift tax liability to low-cost tax jurisdiction.
Now we are going to get into the transfer pricing and taxes part. To better understand how transfer pricing impacts a company's tax bill, let's consider the following scenario. Let's say that an automobile manufacturer has two divisions. Division A, which manufactures software, and Division B, which manufactures cars. Division A sells the software to other car makers as well as its parent company. Division B pays Division A for the software, typically at the prevailing market price that Division A charges other car makers. Let's say that Division A decides to charge a lower price to Division B instead of using the market price. As a result, Division A sales or revenues are lower because of the lower pricing. On the other hand, Division B's cost of goods sold or COGS are lower, increasing the division's profits. In short, Division A's revenues are lower by the same amount as Division B's cost savings, so there's no financial impact on the overall corporation. However, let's say that Division A is in a higher tax country than Division B. The overall company can save on taxes by making Division A less profitable and Division B more profitable. By making Division A charge lower prices and pass those savings on to Division B, boosting its profits through a lower COGS, Division B will be taxed at a lower rate. In other words, Division A's decision not to charge market pricing to Division B allows the overall company to evade taxes. In short, by charging above or below the market price, companies can use transfer pricing to transfer profits and costs to other divisions internally to reduce their tax burden. Transfer pricing and the IRS. The IRS states that transfer pricing should be the same between intercompany transactions that would have otherwise occurred had the company done the transaction with a party or customer outside the company. According to the IRS website, transfer pricing is defined as follows. The regulations under Section 482 generally provide that prices charged by one affiliate to another in an intercompany transaction involving the transfer of goods, services, or intangibles yield results that are consistent with the result that would have been realized if uncontrolled taxpayers had engaged in the same transactions under the same circumstances. As a result, the financial reporting of transfer pricing has strict guidelines and is closely watched by tax authorities. Auditors and regulators often require extensive documentation. If the transfer value is done incorrectly or inappropriately, the financial statements may need to be restated, and fees or penalties could be applied. However, there is much debate and ambiguity surrounding how transfer pricing between divisions should be accounted for and which division should take the brunt of the tax burden. For the last part of the video, we are going to give you guys the examples of transfer pricing. First example is Coca-Cola Company. Because the production, marketing, and sales of Coca-Cola Company are concentrated in various overseas markets, the company continues to defend its $3.3 billion transfer pricing over royalty agreement. The company transferred IP value to subsidiaries in Africa, Europe, and South America between 2007 and 2009. The IRS and Coca-Cola continue to battle through litigation, and the case has yet to be resolved. Second example is Meta. In another high-stake case, the IRS alleged that Meta, formerly Facebook, transferred $6.5 billion of intangible assets to Ireland in 2010, thereby cutting its tax bill significantly. If the IRS wins the case, Meta may be required to pay up to $9 billion in addition to interest and penalties. The trial, which was set for August 2019 at the US tax court, has been delayed, allowing Meta to possibly work out a settlement with the IRS. Last example is Medtronic. Ireland-based medical device maker Medtronic and the IRS met in court between June 14 and June 25, 2021 to try and settle a dispute worth $1.4 billion. Medtronic is accused of transferring intellectual property to low tax havens globally. The transfer involves the value of intangible assets between Medtronic and its Puerto Rican manufacturing affiliate for the tax years 2005 and 2006. The court had originally sided with Medtronic, but the IRS filed an appeal. Both sides are now awaiting a decision from the tax court.